Hey guys, welcome back to another Business Bootcamp video. In today's lesson, we'll be talking about financial economics. Let's get started. So, you may be wondering what the focus of financial economics is. Well, it's quite simple. It's to find opportunity costs and information that can create incentives or disincentives for a particular decision. This means that companies are looking for financial economics that often involve the creation of sophisticated models to test the variables affecting a particular decision. Oftentimes, these models assume that individuals or institutions making decisions act rationally. However, this is not necessarily the case. Irrational behavior of parties has to be taken into account in financial economics as a potential risk factor. If this doesn't make sense, it's probably because we haven't discussed the definition of financial economics. So, let's move on. What is financial economics? Financial economics is a branch of economics that analyzes the use and distribution of resources in markets in which decisions are made under certainty. This is where financial decisions must often take into account future events, whether those be related to individual stocks, portfolios, or the markets as a whole. Lastly, this can let us move on to the concepts of financial economics. The concepts include discounting, which is decision-making over time. This is when companies realize that the fact of the value of $1 in 10 years' time is less than the value of $1 now. Therefore, the $1 at 10 years must be discounted to allow for risk, inflation, and the simple fact that it is in the future. Thus, it can be inferred that failure to discount appropriately can lead to problems. Next, we have risk management, the high return on average in stocks to compensate for the risk. Because financial institutions are always looking for ways of ensuring this risk, it is sometimes impossible to hold too highly risked assets, but the overall risk can be low or high, and vice versa. Third of all, there's diversification, which is figuring out the importance of the amount of risk taken. This is basically analyzing the total risk of a company compared to the risk of the individual components that lead to make up to the company. That's about it for today's video, folks. Hope you enjoyed. Be sure to check us out at www.businessbootcamp101.org for more videos and articles. Once again, thank you and see you in the next one. Bye!